When you think of a company hitting the stock market, you picture a flashy IPO, but that's just the front door. There's a secret backdoor many big companies use to get listed, avoiding the media frenzy. We're exposing the shortcuts that let companies quietly slide onto the stock market. When a company goes public, it's usually through a traditional initial public offering, or IPO. They hire investment banks, pitch to investors, and create new shares to sell, all to get publicity and raise cash. But the IPO process is slow, expensive, and stressful. Banks take huge fees, often up to 7% of the funds raised. Plus, founders face intense pressure and lockup periods where they can't sell their own shares for months. These headaches have companies searching for alternatives. Our first secret method is the SPAC, or Special Purpose Acquisition Company. A SPAC is a blank check shell company that goes public just to raise cash and buy a private company, taking it public via merger. This process is much faster than an IPO, taking months instead of over a year, and the company negotiates its price directly, offering more certainty. DraftKings and Virgin Galactic both went public this way. The risks? The pressure to find a deal can lead SPACs to overpay, and with less regulatory oversight, some deals have fizzled, leaving investors with losses. Next is the direct listing. Instead of creating new shares, a company lists its existing shares directly on an exchange, letting employees and early investors sell from day one. The biggest perk is saving a fortune in fees by cutting out underwriters. There's no dilution from new shares and no lockup periods, offering instant liquidity to insiders. Spotify and Slack use this method. The catch? A direct listing raises no new money for the company. It's a path for cash-rich companies that just want to provide an exit for early backers. The sneakiest shortcut is the reverse merger. A private company merges with an existing public shell company, instantly becoming public itself. This route is faster and cheaper than a SPAC, sidestepping most regulatory checks and media attention. However, this backdoor has a bad reputation. Because of the minimal due diligence, it has been used by risky and even fraudulent companies, causing regulators to crack down and savvy investors to be skeptical. From SPACs to reverse mergers, it's clear the flashy IPO isn't the only path to the stock market. These backdoors offer speed and savings, blurring the line between private and public companies. To learn more financial secrets, subscribe and hit the notification bell. And let us know in the comments, which method was the most surprising to you?